happy Ganesh Chaturthi to everyone. The mighty Lord Vignaharta is the destroyer of obstacles, and at the moment India is facing a rather big obstacle in the form of the 50% tariffs. Well, let me start with the good news. Some goods like pharmaceuticals, autos, auto parts and metals like iron, steel, aluminium and copper continue to attract 25% tariffs. The Global Trade and Research Institute, or GTRI, calculates that out of India's $86.5 billion exports to the US last year, $60.2 billion of exports are going to face the 50% tariff. Now, of course, what can be the impact of the possible loss of markets on India's GDP? Most economists assess the impact to be about 1%, but with only half the year left, the impact is probably 0.5%, but there are other countervailing issues like the GST cut. These are all rough estimates. To understand the macros, the macro implications, I'm joined by two stalwart economists, Soumyo Kanti Ghosh of State Bank of India, also the economist for the Finance Commission, and Santanu Sengupta, the economist from Goldman Sachs, India. Gentlemen, good morning and thank you very much for joining us. Soumyo, to you first. What should we assess? We are going to get one GDP number on Friday, but nearly 6 months of the year is left. What can be the impact?
Oh, thank you, Lata. I think there are two things to this. Yeah, and the first quarter GDP number on I think this Friday and the overall GDP estimates, I think there could be two different narratives. The first quarter GDP number will be quite strong, but look into the nominal GDP numbers because that will give an indication of how the economy is doing in terms of an declining domestic demand. So our sense is that the real and the nominal are likely to converge significantly in the first quarter. So, but the good news from that is that while the numbers of real GDP will be strong enough, the overall for the full year, that may cushion the impact of a fall in the second half because of the tariff impact. Now coming to the downside, I think with the US tariff now kicking in from today, and India, as you know, has an export surplus to US of around 45 to 46 billion. Overall exports is around, I think, 86 to 87 billion. Yes. So even if 50% of that is supposed subjected to tariff, there are varying estimates, but I take the ballpark estimate of 50%, which is closer to our estimates. That means the trade surplus which we had with the US will be eliminated over a full year. But given the fact that if you actually look into the exports to India, USA in April and May this year, that has been actually grown faster than last year because of front loading. And this could have continued till August, I think till the mid of August, when the exporters were actually exporting to take advantage of this, not for the tariff to take impact. So overall, I think there will be, of course, an impact, but there are many ponderables, moving ponderables. Hopefully, if we get a trade deal when there is a visit by the Honorable Prime Minister at the end of September to US, I think that will be good enough. But in our sense, there will be, of course, some impact on the GDP. How far that is cushioned by the cut in GST, that remains something which we need to explore.
Okay. Well, I know for everyone, this is too many moving parts and work in progress. But Shantanu, the average I got from my poll, which I did for the Friday numbers, the average for the full year is coming at around 6.2, 6.3%. What kind of a further downside? Are we staring at sub 6%, assuming that we have to pay 50% for the remaining 6 months of the year?
Yeah, Lata, we are already at 6.1 for the fiscal year 26. We haven't baked in the incremental, which is going to come into effect from tonight. If the incremental comes in, or if on the initial part, our assumption was that the elasticity would be somewhere in the region of 0.5. It's also backed by some research at the sectoral level by the IMF in over the last decade. But if the incremental 25% is to come in on ballpark 60 to 65% of overall exports, it's very likely that the elasticity will be closer to 1 and not really 0.5. At 50% tariff, it is very difficult to export. And therefore, we think that some of these sectors like textiles, gems and jewelry, marine products, etc., will be quite impacted. So, the risk is that you have a number sub 6% for the fiscal year 26. Again, the big uncertainty is as Soumyo said, when this gets rolled back quickly, if you have a deal by the end of next month, this all could be rolled back quickly, and therefore you can again have a growth upside. But as of now, if this stays, just the first round arithmetic tells us that growth would go sub 6%.
Okay. Yeah, that is the fear. But Soumyo, obviously the government will try to do some hand-holding. Now, some of the things that the exporter organizations are asking is, the best they can get is the full 25% reimbursed to them for 1 year till they find, alternative markets. There are others who are asking for not the full 25%, but at least say 20% being reimbursed. There are yet others who are asking for, just interest mitigation through a CGT, MSC or some such package. So, first of all, should we be prepared for a higher fiscal deficit or a higher fiscal spend? Because it's a large number of employees, textiles plus gems and jewelry plus leather, plus shrimps.
I think as of now, fiscal deficit at 4.4%. I don't see any significant upside risks, although I think there will be clamor for more support to the exporters. I think the one way the government is already looking into cushioning the impact. I think one way the government could actually look is that, I think if you remember last year in December 2024, the export credit, the interest subvention scheme was discontinued. So one way is to bring it back, and only for a limited period to the sectors which are impacted, specifically the textiles, gems and jewelry, marine products and others. So that is one way of looking into the thing. The other way actually just to ride over the current storm and see how the impact plays out. I think the government is also trying to assess the situation to see whether we are able to strike a trade deal. Maybe later now, not sooner, because it's already the end of August. So even if you're able to strike a trade deal, maybe by the end of September with some giveaways here and there, I think that's the idea which is going on in the government mind. So in my sense, I think maybe for the next couple of fortnights, the government will actually wait and watch to see how the things are spanning out. And then it will announce the impact. And then it could announce a package. Regarding the impact on fiscal, we are open that the fiscal deficit, which is a 4.4%, even if it slips by a 5 to 10 basis point impact, which is possible given the GST implementation, but also that could be offset by higher consumption. I think that is still better than taking a GDP hit of larger GDP hit over the next year or so. As of now, I think again the impact on GDP will be significantly uncertain. We have already around 20 to 30 basis point impact, but this 50% tariff could actually hurt the GDP a little more if it continues.
Okay, the impact on bonds is at the moment 6.61 is the 10-year. Remember, the 10-year end May was 6.17. There are other reasons why, of course, the yields have gone up, simply because everyone is staring at the end of the rate cutting cycle. But Santanu, what kind of a fiscal impact? You're not looking at a package. You don't think the yields are reflecting the fear of higher fiscal spend and maybe lower fiscal earnings as well?
I would say, Lata, that there are risks to the fiscal deficit from multiple factors. By our estimate, the income tax cut of 30 basis points of relief for the consumer was not really fully budgeted for when the budget was announced. The budget announcement was about 10 basis points of GDP higher for the income tax collection, which would have assumed then job growth or something like that, which we don't think is really happening. Second, nominal GDP growth, Soumyo made this point earlier, nominal GDP growth will be lower. And three, now you have the question that you're asking, which is these sectors, mostly MSMEs, will need some form of support. Now, the support can be through a direct subsidy, in which case it is a direct hit to the fiscal for this year, or it could be through what you saw during the pandemic, maybe a credit line or something on those lines. So it depends on at what point of time you take the hit and through what instrument. But I would say that already that is reflecting, as you correctly pointed out, in the back end of the yield curve where yields have backed up. So the market is, I would think that the market is aware of the fact that some of the fiscal risks are brewing because of not just the tariff, but also nominal GDP growth being lower and the income tax cuts.
Yeah, and the dollar is more expensive by 20 pice overnight and about 50 pice if you take last 48 hours. Soumyo, are we going to stare at 88 very soon?
Yeah, just one point, Lata, I want to mention. I think the feeling in the markets is that the impact on the states could be even more than the centers. That's why I think, as you know, the SDL, I think there's significant upside, the borrowing SDL estimates. And in fact, I think as of now, we are holding our gun and we believe that things could actually get better before it gets worse. But our sense is that there will be an impact on GDP by around, say, 20 to 30 basis point as of now. But beyond that, to speak about an impact when we are actually getting back to an era of protectionism of 1980s, what used to happen in 1980s, that infant industry argument, I think is very difficult to say at this point of time what was the overall picture. But as of now, there are, of course, the downsides could outweigh the upsides to some extent.
Well, truly spoken like a Finance Commission member that the states are going to be impacted more and the SDL yields have risen. Gentlemen, completely out of time, but I will invite you all for a more thorough discussion when, things get clear a bit. Also, Santanu, apologies that we couldn't discuss your excellent report on financial savings, which states that India is probably staring at about a 13% of household financial savings from the current 11% odd. And that will mean some, $10 billion flowing into financial assets over the next 10 years. We will discuss those reports at a time which is more opportune. Thank you very much, Soumyo and Santanu. Wrap up on Bazaar. Chart Past is coming up.